Sometimes you pick up a financial report and it's just walls of text and numbers. You stare at it and think, how do I find the important stuff quickly?
It's a common feeling, especially with big companies doing lots of different things.
Uh,
Overwhelming, right?
totally. But what if you could get right to the heart of it? Find those key insights without drowning in the details.
Well, that's exactly what we're aiming for today.
Hmm.
We're doing a deep dive into Trident Limited's latest results, the quarter ending June 30th, 2025.
Okay.
And we've got the source materials right here, the official board meeting notes from July 24th, the unaudited financials, both standalone and consolidated, and the auditor reports too.
So the full picture?
Pretty much, yeah.
Yeah.
A really comprehensive look.
So our mission here for you listening is to basically pull out the key takeaways, give you that shortcut to understanding what went down at Trident this past quarter.
Exactly. Not just the numbers, but what they actually mean. We'll find some interesting nuggets, maybe clarify some things that look dense at first glance.
All right, let's do it. Where do we start? The big picture view.
Yeah, let's start high level. The board meeting outcome on July 24th. They officially approved these unaudited results for Q1 FY26. Standard procedure.
Got it. So how did Q1 FY26 actually stack up against the same time last year, Q1 FY25? What's the headline?
Okay, so here's the interesting bit. Revenue from operations.
Yeah.
It was actually down slightly.
Oh.
Yeah, just a bit. Standalone was INR 17,002 million, roughly, down from about 17,347 million last year. Consolidated figures show the same kind of pattern. INR 17,068 million versus 17,427 million previously, so a small dip.
Okay, slightly lower revenue.
But, and this is the big but, look at the net profit after tax.
Ah, okay.
It jumped significantly. Standalone profit went from about INR 736 million last year to 1,393 million this quarter.
Wow, that's almost double.
Pretty much. And consolidated the same story. INR 739 million up to nearly 1,400 million.
Okay, hold on. Revenue dipped slightly, but profit nearly doubled.
Exactly.
How does that happen? That's the key question, right? Better margins, cost cutting.
That's precisely what we need to unpack. You see that kind of divergence, and you immediately think, okay, what changed internally?
Right.
Let's look at the segments. Using the standalone data, which lines up pretty well with consolidated anyway, their biggest revenue streams are still yarn that brought in about 9 billion INR in towels, around 6.3 billion. Those are the core businesses.
Makes sense.
But here's something interesting. The segment with the highest profit before finance costs and tax and all that wasn't either of those.
Ooh, which one?
Paper and chemicals. It only brought in about 2.6 billion in revenue, much smaller.
Right.
But it generated over 733 million in profit.
Wow. So much higher profitability in that segment.
Exactly.
Yeah.
Suggests really good margins or maybe, strong operational efficiency there. It's punching above its weight in terms of profit contribution.
Interesting. What about bed sheets?
Bed sheets did okay too. About 3.1 billion in revenue and around 446 million in profit. Solid contributor.
Okay, so paper and chemicals is a standout for profitability. Now, thinking about that overall profit surge, let's talk expenses. Did they slash costs somewhere?
Good question. Let's look. Cost of raw materials consumed. That was about 8.4 billion INR. Pretty standard, big cost for manufacturing.
Naturally.
Employee benefits expense, around 2.1 billion.
Okay.
Now, finance costs. This one needs a bit of context. For Q1 FY26 standalone, it was about 311 million INR.
Right.
Which seems high if you compare it only to the immediately preceding quarter, Q4 FY25. That was super low, only 24 million.
Whoa, why was Q4 so low?
Yes. Note 7 in the results explains it. In Q4, they booked a big chunk, like 367 million INR of interest subsidy income related to some expansion projects. They netted that against the finance cost.
Okay, so Q4 was artificially low because of that credit.
Exactly. So this quarter's 311 million, while higher than that unusual Q4, is actually lower than the 463 million they paid in Q1 last year.
Got it. So finance costs are actually down year over year, just not compared to that one weird quarter.
Precisely. It suggests things were actually improving on the finance cost front compared to last year. And depreciation was about 917 million.
Okay, that finance cost clarification is key. So costs seem reasonably managed, maybe some improvement there, but perhaps not dramatic cuts explaining the whole profit jump alone. What else was going on? Strategic stuff.
Yes, definitely some interesting moves there. First off, the board approved raising funds up to 500 crore rupees.
Okay, how?
By issuing NCDs, non-convertible debentures. basically borrowing money through bonds that don't convert to shares.
Right.
They can do it publicly or privately, maybe in stages. Needs shareholder approval, of course.
What does that signal, usually? Big plans?
Could be. Future growth,
Yeah.
maybe paying off other debt, general corporate purposes. It shows they're actively managing their capital structure, looking ahead.
Okay. What else?
They also paid out an interim dividend, 50 pays per share, always nice for shareholders.
Yeah.
And they sold off a subsidiary, Trident Home Textiles Limited, THTL,
Oh, right. How much for?
about 10.7 million INR. Happened on June 17th. So THTL isn't part of Trident anymore.
So a bit of portfolio tidying up, maybe?
Seems like it. Could be focusing resources elsewhere.
Any other unusual items?
Well, there's the Employee Welfare Trust activity. The trust sold quite a few shares, over 15 million on the open market this quarter.
Okay.
Made a profit of about 307 million INR after tax, which went into other equity. Part of their employee benefits scheme from 2023. So internal movement, but quite substantial.
Interesting. And then there was that auditor's note, right? The emphasis of matter
Oh,
about an income tax search. That sounds potentially serious.
right. That definitely catches the eye. It refers to Note 8. So back in October 2023, the Income Tax Department conducted a search at some company places, subsidiaries, even some employee residences.
Okay. Section 132 search, they called it.
Yes. The company says they cooperated fully, gave information, documents, data, backups were taken, but importantly, operations were disrupted.
And what's the status now?
Well, they received assessment orders for 2 financial years, FY 21-22 and FY 22-23, with some additions made by the tax authorities.
Meaning they potentially owe more tax.
Potentially, yes. But Trident has appealed these orders. They've stated they are hopeful of getting favorable orders on appeal. Nothing new specifically happened on this in this quarter, Q1 FY26.
Okay. But the auditors felt the need to highlight it. What does that emphasis of matter actually mean for us reading the report?
Crucially, the auditors, S.R. Batlaboy & Co., explicitly state their opinion on the financial results is not modified because of this.
Meaning?
Meaning, while they think it's important information for you to be aware of, hence emphasizing it, they don't believe it makes the current financial statements materially inaccurate or misleading as reported for this quarter.
Ah, okay. So it's a flag saying pay attention to this ongoing issue, but not these numbers are wrong.
Exactly. It's about transparency on an unresolved matter. But it doesn't change their overall conclusion that the financial statements give a true and fair view for this period.
That's a really important distinction. Okay, so let's pull this all together then. We've covered revenue, the big profit jump, segments, costs, fundraising, divestment, that tax issue. So what? What does this all mean for you, the listener, trying to understand Trident?
Well, I think the first takeaway is financial resilience, perhaps.
Yeah.
Despite that slight revenue wobble, they showed really strong profit growth. That suggests they might be getting more efficient, or maybe the product mix is improving margins. They can make more money, even if sales are flattish.
Right. Stronger bottom line performance.
Second, they're clearly looking forward. That NCD fundraising approval signals they're thinking about future investment or optimizing their finances. It's proactive.
Not just reacting, but planning.
Exactly. Third, the THTL divestment shows they're actively managing their portfolio, pruning things that might not fit the long-term strategy.
Strategic focus.
And fourth, transparency. Disclosing the tax search details, management stance, and importantly, the auditor's unmodified opinion. It gives you a sense they're facing challenges openly while still focusing on the business.
So this deep dive really shows there's much more going on beneath the surface than just the headline numbers, doesn't it?
Absolutely. You get a much richer understanding of the company's health, strategy, and even its challenges.
We've definitely covered a lot of ground on Trident's Q1 FY26, that impressive profit, the segment performance, the fundraising, the divestment, finance costs explained, and navigating that tax matter. A real mix.
It really is. And maybe a final thought to leave you with. When you see a company like Trident actively pursuing funding, potentially for growth, or while also very clearly managing and disclosing an ongoing complex issue like that tax search, how does that combination, that ambition for growth, alongside transparent handling of operational or regulatory challenges, how does that position them in a fast-moving market like India? What does it tell us more broadly about how companies have to balance pushing forward with navigating the complexities that inevitably arise?
That's a great question to ponder. Balancing growth and governance in a dynamic environment.
Something to think about.
Absolutely. Well, thank you for joining us on this deep dive. Keep exploring, keep learning.